DeFi lending is about to change the game again, but is it a revolution or a disaster waiting to happen? Let's break it all down. The DeFi lending shift, massive growth or inevitable collapse. DeFi lending isn't just about borrowing and lending anymore. The landscape is shifting fast, with billions locked in protocols. But the big question remains, are we heading toward massive growth, or is this an unstoppable DeFi bubble ready to pop? Let's dive in. The evolution of DeFi lending. What's changing? Just a few years ago, DeFi lending was simple and structured. Over-collateralization. Borrowers had to lock up more assets than they borrowed. Risk management. This ensured that lenders were protected from defaults. But now, the game is changing fast. Imagine borrowing without locking up more than what you take. Sounds risky, right? AIve, Maple Finance, and others are already experimenting with under-collateralized and even unsecured loans. On-chain credit scores are emerging, using wallet history, transaction data, and AI-driven risk assessments to determine borrowing power. But hold up. Does this bring TradFi risks into DeFi? Let's take a deep dive. Under-collateralized loans, DeFi's biggest risk yet. One of DeFi's biggest promises was eliminating intermediaries and creating a truly decentralized financial system. But with under-collateralized and unsecured lending, are we reintroducing the same risks that nearly collapsed TradFi? Let's break it down. Massive defaults. A 2008 crisis in DeFi. In TradFi, banks collapsed in 2008 due to reckless lending and bad debt. Without strict risk controls, DeFi could face high default rates, borrowers with low creditworthiness taking out large loans they can't repay. Chain reactions. If one major borrower defaults, it could trigger panic and wipe out liquidity across platforms. Debt spirals. If DeFi protocols lend based on unreliable on-chain credit scores, defaults could pile up quickly. Smart contract vulnerabilities, bigger targets, bigger losses. DeFi lending platforms rely entirely on smart contracts, but with more complex loan structures, we could see more attack vectors. The bigger the loan pools, the more attractive they become to hackers. Exploitable credit systems. On-chain credit scores might be manipulated or gamed by bad actors. Flash loan risks. Unsecured lending makes it easier for flash loan exploits to drain millions in seconds. Liquidity crunches. The DeFi bank run scenario. In TradFi, when panic hits, banks collapse overnight. DeFi is no different. Lenders may suddenly pull liquidity, draining funds from entire platforms. If users lose confidence, borrowing rates could skyrocket, making loans unaffordable. DeFi lending markets could freeze, trapping funds in an illiquid crisis. That's why DeFi platforms are turning to AI-powered risk management. Let's break it down. AI plus. DeFi. The future of credit scoring? DeFi is evolving fast, and AI is now stepping in to redefine lending. Instead of relying on traditional collateral, DeFi is integrating AI-driven on-chain credit scores to determine borrowing power based on real activity. How AI-powered credit scoring works. Analyzing user behavior. AI tracks how you interact with DeFi platforms, looking at lending, borrowing, staking, and trading habits, transaction history, and wallet reputation. The longer and more active your wallet is, the stronger your on-chain credit profile becomes. Smart credit unlocks. High credit scores could open access to loans without insane collateral requirements. Dynamic adjustments. Unlike TradFi, where credit scores take years to update, on-chain credit scores could adapt in real time. This could be a game changer, allowing responsible DeFi users to access bigger loans with lower barriers. But hold up. AI risks. Are we handing power to algorithms? AI in DeFi sounds revolutionary, but it also introduces serious risks that could undermine decentralization. Bias and manipulation. Can AI truly be fair? AI models are trained on historical data, which means biases can creep in. If the AI favors certain transaction patterns, it could unfairly limit access to loans for some users. Bad actors might game the system by mimicking high credit behaviors to trick AI into granting massive loans. Privacy concerns. Do we want AI tracking? every transaction, AI-based credit scores require deep access to wallet activity and transaction patterns. This could lead to mass surveillance, where DeFi platforms track users just like banks do. In a decentralized world, should we sacrifice privacy for convenience? Centralization fears? Who really controls AI? If AI models decide who gets loans, who owns and controls these models? If major DeFi platforms adopt centralized AI scoring, the power shifts away from decentralization. Could we be recreating the same centralized financial system that DeFi was meant to replace? The big question, can AI and DeFi work together? AI-powered credit scores could unlock a new era of DeFi lending, but the risks are real. If not properly decentralized, AI could introduce bias, privacy violations, and centralization, turning DeFi into just another TradFi system. This is where things get even crazier. Real-world assets, RWAs, in DeFi. A game changer? DeFi lending has always been crypto-native, but now it's breaking out into the real world. What if you could tokenize physical assets and use them in DeFi lending? Imagine a future where real estate-backed DeFi loans, borrow against your house without dealing with banks, tokenized bonds and government securities, traditional safe haven assets integrated into DeFi, luxury assets like watches and cars as collateral, use high-value items to unlock liquidity instantly. This isn't just a concept. MakerDAO, Goldfinch, and Centrifuge are already making this a reality. The catch: does tokenizing RWAs change DeFi forever? RWAs could bring massive liquidity into DeFi, but they also introduce complex challenges that could reshape the entire ecosystem, bringing TradFi risks into DeFi. Unlike crypto-native assets, RWAs exist in the real world. If someone defaults on a tokenized real estate loan, who enforces the collateral seizure? What happens if tokenized bonds or securities become non-performing? Legal and regulatory uncertainty. Governments heavily regulate real-world assets. Will DeFi projects have to comply with strict KYC and AML laws to manage RWAs? If regulators step in too aggressively, could RWAs become too centralized for DeFi's original vision? Smart contracts and security risks. RWAs require bridges between physical assets and blockchain networks. If a smart contract fails, could people lose ownership of tokenized assets? Can DeFi lenders trust oracles and valuation mechanisms to keep RWA pricing fair? The future of RWAs in DeFi: boom or bust? RWAs could bridge traditional finance and DeFi, unlocking trillions in new liquidity. But they also bring legal, security, and decentralization concerns. The regulation problem. Is DeFi about to get censored? As DeFi evolves and real-world assets, RWAs, start playing a major role, governments around the world are taking notice. Why are regulators stepping in? Governments have always had control over traditional finance. Now, with billions in value flowing into DeFi, they can't afford to ignore it. As DeFi becomes more mainstream, the lines between traditional and decentralized finance are blurring. Tokenizing real-world assets, like real estate, stocks, and bonds, opens up a whole new world of regulations. Governments want to ensure safety, prevent fraud, and ensure that taxation is properly handled. The impact of regulatory crackdowns. While regulations could lead to a more mature and stable market, they could also stifle innovation and kill DeFi's original decentralization goals. New rules could enforce Know Your Customer, KYC checks, introducing centralized controls that would run counter to DeFi's decentralized vision. Governments could impose regulations on who can borrow or lend, potentially locking out certain users from the ecosystem. The three possible futures for DeFi lending. So where does DeFi go from here? The future is uncertain, but there are three possible scenarios that could define the next chapter. The golden era: AI-driven lending and tokenized real-world assets combine with mass adoption. DeFi becomes mainstream, offering unprecedented opportunities to challenge traditional banks and financial institutions. DeFi could become the go-to option for borrowing, lending, and investing, changing the face of global finance. The regulatory trap. Governments impose strict KYC, AML rules, and centralized controls to monitor DeFi platforms. Innovation slows as platforms are forced to comply with regulations designed for centralized systems. Decentralization could take a hit, making it harder for DeFi to retain its core values. The collapse, unchecked risks like over-leveraging, smart contract vulnerabilities, and lack of liquidity cause major market disruptions. A crash similar to the 2008 financial crisis could shake the entire DeFi ecosystem, causing a loss of confidence. Platforms that cannot adapt will likely face a collapse, setting DeFi back for years. The rise of on-chain credit scores. A game changer? On-chain credit scores could revolutionize the lending space by making it easier to borrow and lend without the traditional barriers. Imagine borrowing more than you deposit or getting access to unsecured loans. This opens up new possibilities for mass adoption of decentralized finance, DeFi. Under-collateralized loans could attract more borrowers, especially those without enough assets to lock up as collateral. Unsecured loans would introduce a new level of trust in the system, based on your on-chain reputation and past DeFi interactions. No more over-collateralization. No more locking up assets you don't want to part with. Just your DeFi track record speaking for itself. But we must ask, are we introducing the same risks that traditional finance carries, such as defaults and market crashes? If users default on loans, the entire DeFi ecosystem could be impacted, leading to a potential collapse of liquidity and trust. Could these innovations amplify risks in DeFi? Without solid risk management, this could quickly turn into a dangerous game for both lenders and borrowers. AI plus DeFi. Smart lending or algorithmic takeover? AI is already playing a significant role in transforming how we view creditworthiness and lending. It's not just about your assets anymore. It's about your DeFi reputation. AI-powered credit scoring analyzes user behavior. How often do you participate in DeFi? Transaction history. What's your track record of repayments and interactions with protocols? Wallet reputation. Is your wallet trusted by the community? As you interact more, your score improves, potentially unlocking access to larger loans, all without collateral. Imagine a future where your on-chain credit score opens doors to massive borrowing power based on your DeFi activities alone. For lenders, AI could provide a more accurate, data-driven approach to determining creditworthiness, reducing the risk of defaults. But there are significant concerns to consider. Trust in AI. Can we fully rely on AI in the decentralized space? AI algorithms are designed to analyze patterns and make decisions. But what happens when they fail to account for complex human behaviors or unforeseen scenarios? Could AI become biased, leading to discriminatory lending practices? Privacy. Is it a good idea to let AI track every transaction you make? Could this expose personal financial data that should remain private? Big questions about whether AI-driven lending systems can ensure user anonymity and privacy in an increasingly transparent world. Lastly, centralization concerns loom large. AI-driven platforms might control the future of lending, but this raises the issue of who controls the algorithm. Is the system truly decentralized? Or are we just shifting power from traditional banks to algorithms? If AI takes over the approval process for loans, the entire system might lose its decentralized essence. Instead of peer-to-peer lending, we could be moving toward algorithm-controlled finance. What do you think? Can we trust AI with our financial future? Does decentralized finance still feel decentralized when algorithms control everything? Let me know in the comments below. The idea of tokenizing real-world assets, RWAs, and using them as collateral in DeFi lending is one of the most innovative developments in the space. By moving physical assets into the digital world, we unlock huge liquidity pools that could revolutionize how we think about lending. Imagine tokenized cars. Your car's value could be used to back loans in DeFi. Tokenized real estate. Use the value of your property to access liquidity quickly. Luxury assets, from watches to jewelry, all tokenized and ready to be leveraged. Platforms like MakerDAO and Goldfinch are already exploring this concept, creating opportunities for billions in new liquidity to flood the DeFi space. The possibility to unlock your car's value, for example, and get a DeFi loan instantly sounds like something out of a sci-fi movie. But it's happening now. Tokenizing RWAs in DeFi opens up a world of opportunities for both borrowers and lenders. Lenders can get access to diversified collateral beyond just cryptocurrency. Borrowers can unlock liquidity from physical assets that have been locked up for years, but this brings a massive new challenge. The moment we bring RWAs into DeFi, we invite regulations. As exciting as the idea of tokenizing physical assets in DeFi is, it also brings regulatory challenges that cannot be ignored. The moment RWAs enter DeFi, governments will take notice and will likely see increased scrutiny. Tokenized real estate, for example, could fall under real estate laws that vary by jurisdiction. Luxury items like watches and cars are high-value targets for theft or fraud. Regulations will likely tighten to ensure they are handled properly in the digital space. Bonds and government securities are highly regulated assets that, if tokenized, would require compliance with financial regulations and government oversight. Governments are watching closely. SEC in the US, EU, and Asian regulators are already drafting rules to regulate how these tokenized assets will be used in the DeFi ecosystem. As soon as real-world assets are tokenized, we can expect these regulatory bodies to take immediate action to ensure that the systems involved adhere to existing financial laws. If regulations tighten, DeFi lending platforms could face challenges, forcing them to implement Know Your Customer, KYC procedures, or centralized controls, which would slow down innovation and limit user anonymity. Regulations. Will DeFi survive or be crushed? Will regulations create a safer, more mature DeFi lending space? On the one hand, regulations could provide much-needed clarity and safeguards for users. They might protect investors, reduce fraud, and help the space gain legitimacy in the eyes of traditional finance institutions. In a regulated environment, DeFi could attract more institutional investors, which could lead to further growth. Or will they kill innovation and drive DeFi underground? On the other hand, stricter regulations could suffocate the spirit of decentralization and lead to compliance-heavy systems that no longer resemble the open, permissionless finance that DeFi was built on. Innovators could be forced to move their projects offshore or into private networks, creating a fragmented system. We might also see DeFi developers abandon high-risk projects in favor of safer, more regulated ones. The loss of anonymity could scare off users who value privacy, and the need for centralized oversight could destroy the very thing that made DeFi appealing in the first place. The big question that will determine DeFi's future. Can DeFi evolve and thrive under regulation without compromising its decentralized nature? Or will regulations push DeFi into a corner, making it less accessible and stifling its growth? The next few years will be crucial for DeFi lending, as it faces its biggest challenge yet. A battle between maintaining its decentralized roots and meeting the demands of governments that want to ensure compliance and safety. The three possible futures of DeFi lending. DeFi lending is entering a critical phase where its future could go in many directions. Here are the three most likely scenarios. The golden era. AI-driven lending, tokenized assets, and mass adoption push DeFi lending to new heights, potentially challenging traditional banks. As decentralized finance gains more trust and stability, it could become the dominant way to borrow and lend, bringing a new era of financial freedom and accessibility. Imagine a world where DeFi not only replaces traditional banking, but outpaces it, offering faster, more secure, and global financial solutions to anyone, anywhere. The regulatory trap. Governments step in, forcing KYC, centralized controls, and regulations to prevent misuse. While this brings legitimacy to DeFi, it could also stifle innovation, slow adoption, and bring centralization back to the forefront. Regulatory pressures could push developers to compromise on decentralization principles, and many DeFi platforms may have to adopt traditional financial structures to comply. the growth of DeFi could slow down as it battles with compliance issues and higher costs. The collapse. If unchecked risks, over-leveraging, and smart contract failures continue, we could face a major crash that shakes the entire DeFi space. With new projects flooding in without proper risk management, we could see massive defaults, liquidity crises, and market instability, similar to the 2008 financial collapse. This would not only damage the trust in DeFi, but could also make it more difficult for innovative projects to get off the ground. Which future do you see happening? Are you ready for DeFi's next big leap, or are you worried about what might go wrong? Drop your thoughts below. DeFi lending is at a crossroads. Are you ready? The opportunities are insane, but so are the risks. To stay ahead of the game, like this episode, subscribe for more updates, turn on notifications so you never miss out on critical insights. Follow us on X, YouTube, Instagram, TikTok, Threads, Snapchat, Medium, Argo, True, Crypto Insights, podcast, Crypto Tribex blog, truecryptoinsights.blogspot.com.